Hey, welcome to this edition of Heim Time. I have the lovely Amanda Dusenberry here with me again. Welcome back to our podcast. Thank you for taking time out of your schedule to go over some stuff with us and kind of hit up our topic today, which is interest rates. The Federal Reserve just cut interest rates last week. I know it's been a little bit of from the time of this recording, been about a week and a half, but kind of wanted to get your perspective on what's going on in the market with interest rates, affordability, all that stuff from a lender side. So welcome to the show. And for those that don't know who you are, just tell us a little bit about yourself.
My name's Amanda Dusenberry. I've been in the mortgage business for, 30 years as of May. I was 5 years old when I started. And
nice.
I know.
That's what I was thinking.
Yeah, I bet. So I'm the branch manager of Veterans United Home Loans, and I also originate, and I'm glad to be here. Thank you for having me again.
Wonderful local resource that we have with you and your knowledge and experience. So I know I've leaned on you many times,
well,
and your team and your team for questions there. But let's jump kind of into the big topic, right? Mortgage rates not mortgage. Our Federal Reserve had their meeting last week on the 15th and 16th of September, and they came out and said, we're cutting it by 25 basis points.
Right.
What does that mean?
Quarter of a point. So, if you're at a 6%, that would be a 5.75. If it were dollar for dollar exact, that's what that would mean. It's just 25% of 1%, right?
Yeah.
It has been an interesting week, to say the least. Well, a little over a week, I guess now.
Yeah.
A lot of the general public assumes when this happens that it's an automatic rates are going to go down 0.25%. And so our phone calls increase a lot. People that are in processing already locked immediately want to know, do I get a better interest rate? Things like that. Mm-hmm. But, what's important to know is that, the Fed doesn't set mortgage rates. Right. The Fed is really tied more to short-term money between banks, right? And so the mortgage rates are more tied to the bond market. Now, one can impact the other, but it's not a direct correlation. So it's not a dollar for dollar, like you said a while ago while we were talking. It's not a dollar for dollar impact there.
Right.
So, and a lot of times, if they see this coming and they predict that the feds are going to drop rates and it will eventually get to us, then you'll see rates go down preemptively ahead of time. And so it's kind of already baked in before it happens. Yeah. And so when the actual Fed rate cut is announced, sometimes rates will actually bump up a little bit. Sometimes they just stay the same because it's already built in.
Which is what we saw anyway, right? It's we've seen a drop, and we won't get into specific numbers, but from a year ago to now, I mean, the average mortgage interest rate, I mean, they peaked up close to, I will say this, they peaked close up and tipped over with some banks over 8%.
Yes.
And we're seeing those, I just had a client lock in, I think, on a VA loan with some rate buy down, right? We'll talk about that a little bit later. But I mean, he locked in at 5.1, 5.3. Yeah. So from when they were at the peak around that, they're sitting that five, like anywhere between whatever number it is, right? They're down two points, let's say, or 2 percentage points. How does that affect that payment? Because that's what the client's looking at, right? They're like, they do worry about, do you see them more, I guess let me ask this question. Do you see them worry more about the interest rate, or do you see them worry more about how it's going to affect the dollars out of my pocket, right? Because I get a lot of clients that are like, great, what's the interest rate? But also,
what's my payment?
Yeah.
So the answer is both. Yeah. But we're seeing less people focus on the rate and more people focus on the payment versus the rate. And kind of. So let me clarify that a little bit. As soon as rates were, when rates were down at 2 and 3%, and then they went up, and there was this period of time where people are like, I've got a 2% rate. I am not going to get a 6% rate. I am not going to go that high. now the people that, that's been several years now. The people that are coming in now to buy are really, they've never experienced the 2% rate, the 3% rate. So to them, 6 is normal. It's just normal now. So I don't want to say they don't care about the rate. Of course they care about the rate, but they're more like 6 is the norm, or in that, again, I'm not quoting an exact rate. I'm just saying basing it off of 6. Yeah. If you go back to before, right at the end of when rates were really low and there was a shortage on inventory and, 20 people were trying to buy the same house.
Right.
And they were having to pay 20 or 30,000 over price to get a house, and they were having to pay all their own closing costs and, all of that. If you would have given them the option at that moment to go, hey, instead you could have a 6% rate and not put any of that out of pocket, they'd have jumped at it. So now they're at a higher rate, but it's still a buyer's market. Sellers are paying a lot of concessions, if not all.
Right.
So to go with the rate drop, if a rate goes down, let's just say $300,000 house, rate goes down 0.25%, you're looking at $50 difference a month, which I know every dollar counts. Every dollar counts. It's absolutely. However, there's ways to make up that difference. So for people that are kind of on the fence, like, well, they've been hearing the rate's going to drop, the rate's going to drop, the rate's going to drop. And so a lot of people stand back and wait on that, and it may not get to where they want in the time that they need it. So, my thing with them is to educate, how can you get that $50 difference without waiting on the rates to drop? Or more of a difference, perhaps, right?
Right.
So,
which you referenced a little bit is through, seller concessions, and which is what the seller's going to offer the buyer, right, as they're buying. And we're pretty heavy in our local market in new construction, right? And a lot of smaller builders and even the larger tract builders are offering different incentives to move their product, right? Move their houses to new construction because they got to sell it. But are you seeing more people worried about a rate buy down versus the actual interest rate, what I would call par on the interest rate?
No. So it used to be low rate, no origination, no discount. That was just the norm. And now it's the norm to have a cost associated with the rate.
Yeah.
It makes a huge difference to the buyer, and it's a very little extra cost to the seller side.
Right.
So, we'll have sellers that'll call and say, how do I move this house? And they'll offer, what if we paid $20,000, but we don't want to pay this, and this? What does it matter if it's in that 20,000, right?
Right.
So you can have, if the seller's agreeing to pay a certain amount and you don't omit things like discount points, that if the seller's willing to pay it already, that makes a huge difference. It can overcome that $50 difference. You think, okay, let's say the seller's willing to take $10,000 off of a price of a house. It's been sitting a long time. Somebody's going to make a lower offer. I'm not talking new construction. I'm talking existing. And they're going to negotiate and try to offer less. That $10,000 difference is $60 or $70 difference a month on the buyer's payment. Instead of doing that, use that $10,000 towards rate buy down or paying off a debt. That's a huge difference.
Yeah, because that opens up your buyer pool.
Right. It sure does. I mean, we have people all the time that have little loans, $3,000 loan, $2,000 loan, and those payments are $150, $180, $200.
That's true.
I mean, it's a huge difference. You take that same $10,000 and you apply it to paying off that debt and maybe a rate buy down, and you've just saved $200, $250 versus waiting on that quarter drop of rate that may or may not come.
Yeah, I had a client recently reach out, and he's like, I was referred from somebody. I was like, great. And I said, okay, talk to me about your situation. What's going on? And he goes, well, I'm trying to buy a car and I'm trying to buy a house.
Yikes.
And I said,
wait on the car.
Stop buying the car. Do not buy the car.
Do you want to live in the car?
I said, actually, I first said, do you need the car right now?
Right.
Do you already have a car? Or do you need a new car?
Right.
He goes, no, I don't need it right now. I'm good. I said, great. Then buy the house first, because you and I talked about this probably 2 years ago.
We
right?
did.
What was and you threw out a number around like it's if you have a $50,000 loan or something like that.
We were talking about 300 last time, but let's be
Yeah.
real, you don't get a $300 car payment anymore.
Right. No.
And so $600 car payment is a difference of qualifying for $100,000 more on a house.
Yeah, say that again. So
$600 car payment
mhm.
is approximately $100,000 more on what you'd qualify for a house. If you go out and buy the car, you get a $600 payment that could lower your pre-approval amount by $80,000 to $100,000.
Right. So if you flip that script, right, and I get a house first,
Yep.
and then I go buy a car,
Yeah.
how much is that going to affect how much car I'm pre-approved for?
Well,
A little, not $100,000, not that.
a little bit, but my hope would be, and this is me who mothers and cares, like I want people to stay within their budget, right?
Absolutely, we all do.
But you need the house more than you need the car. You need transportation, but you might not need the one that they're going to sell you that
Right.
is the fancy, whatever. But my hope would be that they get the house that they need and want, and then they let the car fit the rest of the budget, right? Don't try to go out and buy the same $600 car payment.
Right. Needs versus want, right?
Yep.
And we talk about this all the time, and obviously, people could say we're biased this because you're a lender, I'm a realtor, we're in this business, but it's really, if you look at data, and I'm extremely data driven on stuff, and I know you are too, is if you look at the sad part right now with affordability is if you look back 15, 20 years ago when everybody says, oh, I bought it at 10% interest rate or 17% interest rate, right? 30, 40 years ago. The average homeowner was 24 years old when they bought their first house.
And the price was much lower.
And the price was much lower. Now fast forward, it's the average as of this year. I think NAR data stated that it was 38 years old as the average first-time home buyer.
38.
38 years old. So I spoke to a colleague of mine and a very wise man, and he said, it doesn't matter what price point you go in. It doesn't matter what is affordable to you. What can you find in that affordability range? But the point of the matter is get in the game.
Right.
Because the other side of that is that the average homeowner has 38 times the wealth that somebody renting.
They're buying something that's going up in value.
Going up in value, right?
The car's not going to go up in value.
It's a depreciating asset, right? And it's not even an asset; it's a depreciating liability.
Right.
But let's get that right. But
right. You're talking to someone who loves to buy cars. Anybody that sees me on this is going to be like, you are a hypocrite. But yeah,
no,
agreed.
Anyway, we won't go down that road. But you buy cars the right way, right?
Yes.
Yeah.
So, yes, I mean, I think there's this balance between people waiting to buy when they're comfortable. They should buy when they're comfortable, obviously. I don't want anybody to buy a home if they're not comfortable doing it. But sometimes they're waiting for the perfect moment to do it. But while they're doing that, I think you were the one that said this morning when we chatted, they're losing out on that appreciation and the time they would have owned it if they went ahead. Because, prices are probably not going to go down.
You market whatever, if you want to, whatever TikTok stream you're on or algorithm or news channel you're watching, right? Are we in a bubble or are we not in a bubble?
Right.
Right. And what I encourage people to do is take that national data and bring it to your local market, because what's happening on a national level, like what's happening to your colleagues in Florida. I mean, you go to a conference twice a year, I believe, right? And you meet with people from all over the country.
Yeah.
And
it's
different stories, right? What's happening in Florida and what's happening on the coast, New York, LA, whatever, is not Clarksville, Tennessee.
No. In fact, it's funny you say that because, we do have branches all over the U.S. And I remember for years before it happened here, people talking about shortage in inventory and how hard it was to find a house. I'm like, oh my gosh, that doesn't happen here. And then it did. Then it did happen here. I think that's another thing too. I think while people are waiting for the rates to go down, they're not thinking if rates go down a certain amount, then all of a sudden more people are going to want to buy. And then you're going to go back to having multiple people trying to buy the same house, which is going to cause seller concessions to go down, it to flip to be in a seller's market. So I think there's and again, back when that happened, people still bought homes. I cannot believe the number of parents that all of a sudden started giving their kids money to buy homes.
Oh, back when it was 2%? Yeah.
Well, back when they were having to pay money over price and
yeah. All this money came out of the woodwork.
I know. It's like,
I remember saying that. I'm like, where did all this money come from?
I know.
These people 6 months ago said, I don't have $1.
$500 earnest money.
Yeah, I give $500 earnest money down. It's like, now you're coming up with 40 grand. Like, and there were some people out there running. I mean, our take on it, my take on that was like, this has got to stop because you're just increasing that market. But so let's jump over to refinancing and home equity, because we have people that have bought
Yep.
in that last year or two, where it's been, now we hit the peak, we're coming down, right? Current stating our interest rates are lower than that. We're not predicting the future, but so refinance and HELOCs, or home equity line of credits.
Yes.
Getting any phone calls lately?
Yep. Every day.
Yeah.
Every day, multiple. Probably my phone's been ringing over here, so it's probably for that. On a VA refi, you only have to have a half point difference, half a point lower on rate to qualify. There's some other qualifications as well, but that's the main thing. Now, in my opinion, is a half a point worth it? No. Now, people will want to do it, and if somebody calls me and they're going to do it anyways, I'm going to do it for them. But what you have to kind of balance out when you're looking at the refinances is how much is the cost and how much is the savings, and how long will it take you to recoup that cost? Because if it takes, 2 years to recoup that and you're going to sell the house in a year, please don't refinance.
Doesn't make sense.
No, the lender's going to make money on your refinance, but you're going to lose. And then if they finance extra to do that, then you're going to have trouble selling their house.
Right.
Once they come to list it with you.
And when you do refinance it, I'm not saying you do this, but most lenders will put, let's say it's 3 or 4 years down the road, they're going to push that back out to another 30 year, correct? Or let's say it's not a 30 year. They're going to push it back out, which when you look at how your amortization works, you're now just paying, you're basically resetting that loan. You might have saved, but what's your end goal?
Well, right? And that's what I want to be sensitive to there. I agree with you 100%.
Yeah. And I know it's a balance, right? But it's more look at the whole picture, not just that one number of what I'm going to save a month.
Right.
Look at your cost, and then look at your short-term cost, which you're talking about, right?
Right.
I'm going to charge you the bank's going to recharge you on that, or lender's going to charge you on that, which they have to make their money, whatever. Right. But also the long-term costs around now, you might be 5 years in, so you're starting to pay more on your principal versus your interest. And what's that long-term look like? Most
people that we're seeing right now are in it less than a year.
Really?
Less than a year. And so there is that. But what I have to be sensitive to when I'm, when we're talking to see if it's worth it or not is, in some situations, $200 can make or break everything. Right?
100%.
And so I feel like I'm getting a lot of people that call that we didn't finance them the first time. And, they're like, hey, about this house, and was told I could just refinance. But so they're banking on the fact that rate was going to go down because maybe they felt a little overextended to start with.
Sure.
So in those cases, again, they're going to do it. But, my hope is that they do it in a way that the cost is minimal. What's being added on is minimal. Right. That if they need to sell, they'll still be able to do that. They won't be upside down in that. And so that's just the things we talk people through before we do it. Again, if they're going to do it and it fits the guidelines, it's not up to me to decide. It's up to them. But again, we want to make sure that it's beneficial and it's not going to be harmful in any way. Does it make sense?
Yeah, and I think that's the conversation is that whoever you reach out to on that, if you're in that case watching this, if you're in that situation, ask those questions, and that's more what we want to convey is that asking those questions around like, what does that cost? How long does it take me to recoup it? What does that look like in my budget? Because absolutely, I mean, budgets are budgets. Money's tight. What you got is what you got. And if you could free up $200, I'd love that $200 more in my bank account, right?
Sure. Yeah.
Every month to, I mean, groceries are through the roof, all that kind of stuff,
Yeah.
right? And just life in general. So,
And again, it's every situation is different. Every client is different. Every need is different. And so I think that's why it's really important not to just throw together a refinance offer and throw it out there, but do you still live there? Are you going to be there? Are you selling? Or is, sometimes it's a divorce situation. So there's lots of situations. I had a rush when you talk about HELOCs. HELOCs are a good option sometimes in certain situations, but I had a rash of people that got HELOCs at some point, and they came back to me to do a cash out to pay it off because they couldn't get it paid off. It's like a big credit card. When they get an interest only HELOC, the payment's low. They're like, I can afford this, but then it never gets paid off.
Yeah, you're just paying the same amount.
You're just paying the same amount. You still owe the full amount. And so again, there's a good use for them. There's a good purpose for them in the right situation.
Right.
But again, I've had a ton where, people were asking about that as an option to get relief from that. So I just would warn everybody to just talk to somebody, not just a lender, but to a financial person, to, a mentor, somebody, just to get the full ins and outs, good, bad, and ugly on that, just so you don't get stuck in a situation like that.
Yeah, that's what a lot of people don't understand is that a HELOC is that payment you have in your month that's the interest on it.
Yeah.
You pay that every month. It's not moving that a dime. So you're right. And there are good situations, right? Whatever that is, we won't go into those, but and they become personal. But I always say, don't, if you want a boat, don't do it on a HELOC. If you want a car, if you're buying a kid a car, don't do that. I've just seen as that house appreciates, right? I've been in kitchens where it's like, they got 2 or 3 different like loans on the back end because they refinance. You pull the numbers and it's every 2 years, the house value went up, but then they refied it. Well, or they did a HELOC on it and added more money to it. And it's like, what are we doing here?
It's no fun telling somebody they can't sell their house.
Right. Delayed gratification is a thing that.
Yeah.
Anyway, sorry, that's a little personal, but delayed gratification. Anyway.
Everybody wants stuff now, which we're all guilty of.
We are, absolutely.
It's easy to get anything. It's just, you don't have to wait. You don't have to save money. You can just go and do it. But, I try to, especially with first-time home buyers, I try to take extra time to kind of talk them through. And not only that, but, people that are coming in and buying their first starter home, I talked to them about, and this is how I set mine up. I bought investment properties over the years, and I bought that first one. They'll say, well, I'm looking for this. I'm like, that budget, you may not get everything you want, but that's a starter home.
Yep.
And so I would buy the one I wanted, or maybe not the one I wanted, but the one that fit my budget. And then I would live in it for a year or so, and then I would rent it out and buy another one. So now I've got an investment property. So now I've got 2 homes that are appreciating in value. And I don't know. I try to talk to them about that, and that's not for everybody. And obviously you have to be set up, to prepare for the things that can happen with that. But I've had several customers over the years that we talked about it early on years ago, and now they're, have several properties, have a portfolio, and it's a great investment. So, it's some of it's scary and there's a lot to consider, but it's, knowledge, knowing it, being informed, and then, doing what's best for each person. So.
Yeah, absolutely. So back to the Fed and their recent cuts, right? What does the Fed cut signal to builders, developers, and real estate investors in the market today?
I mean, I think when they hear about rates going down or cuts, that gives them encouragement that to maybe, do more, develop more, build more, whatever. I think it's an encouragement to them to see some movement, maybe if homes aren't selling, aren't moving, to see that movement's coming, and maybe keep them moving forward on it. I don't know. What are you seeing? Because you work more.
Yeah, I think that it's the cost of money, right? And everybody's looking at the cost of money. And if I can get, I have investors that take pictures of the bond market They don't even look at a Fed cut. They look at the bond market and they're like, it's coming.
Yeah.
It's coming. Like rates are going to come down, which they're not wrong, right? They do that for a living, right? And they study the market. So what's the media saying about the current state of our economy?
The hard part is people hear the media from
A national
level, like you said. But I think, we were talking about some of your questions were about confidence, right? And so I think that has a lot to do with it. When you see builders out and they're building more homes and they're, that's encouraging.
Right.
So I think all of it kind of plays in together, obviously, but
yeah, I go back to one of my favorite sayings is, what's the number one reason that people stop buying houses? It's because other people stop buying houses.
Right.
Number one reason people start buying houses is because other people start buying houses.
Okay.
It's a mob mentality, or okay, cool. Oh, I'm gonna have confidence in there because I want to be like most people.
Right.
Well, if most people are stopping, I'm gonna be like most people. I'm gonna hold back and go.
Right.
I'm gonna wait. Oh, well, people are starting. Okay, well, let me look at this and see what's going on. That's why it's so hard to time a market, right? Or you're never going to be able to time a market, right? Because when the peak happen is when you're starting to
already going down.
Already going down. When you're at the bottom is when you start going up, right? So, and housing is, for the Federal Reserve and what they look at, that's a leading indicator around how the economy is doing and that kind of stuff. So the housing market and somewhat the car market, but more really the housing market. Yeah. So,
but you are right. All it takes is your friend telling you they're buying a house and now they're looking. Yeah, for sure. That's why we get so many client referrals, because my buddy is buying. They told me to call you, and that's true.
Have you noticed a shift in buyer urgency?
The ones that, we had a ton of calls, right, when they talked about the Fed's cutting rates. When they realized that the change wasn't then and moving forward, like it had already happened. Some of them said we're going to wait a little longer and see what happens, which is fine. And then, but I think realtors are informing clients more also nowadays too, and so I think that people are understanding, hey, if those rates drop substantially, like we said, it's going to shift a lot more things than just getting a lower payment. And so I have seen a big uptick and a little bit more of an urgency. Yes.
Yeah.
It's just now on the front end of it though.
Yeah. Yeah. I think that, seasonality, we're sitting here and it's end of September, almost October, right? So seasonality is a thing, right? I have a client right now. You're familiar with them. First time home buyers. And wonderful young couple. And the first thing I said to them when we walked in for our buyer strategy session last week was, I am so proud of you guys, because we've been talking with them, help their parents, help this, like, anyway, it's a family situation. It's third person in the family buying. And these two have been working for 3 years.
Wow.
And they started the conversation with me 3 years ago and said, what do I need to do?
Right.
So, well, you need to do this. Call lender. Do this stuff. Call Amanda. Get this set up. See where you're at. And they got on a plan. And it was like, okay. And it wasn't, it was just, they needed a plan around what to do.
I love it when they do that.
And that's the education piece that I think and that's what triggered it, as you said, agents or realtors are educating, and that's the key, is that I don't care if it's 3, 4, 10 years down the road.
Yes, you've worked with them a long time.
Like, just set up a plan, and let's stick to the plan, and it'll happen.
Would you call it a buyer strategy plan?
Buyer strategy session.
I love that. That's good.
It's not a consultation.
No.
Consultation is what I do when I'm, getting braces or something. I don't know.
Are you getting braces?
No.
You don't need them.
No. One of my children just got braces.
Oh, yeah.
I'm taking donations. But anyway.
You need that quarter-point drop.
Even though $200 a month, right. There it is.
Yeah, that won't get it. That's like 50. No, just so.
But yeah, it's making that plan and getting early on with it, and saying, okay, here's what I need to do. And I think that's where a lot of people are in any market, right? And the other question I always ask is when I get asked some of these, obviously I'm not a lender, so I'm not going to go into those questions.
Sure.
But one of my main questions I ask is, how long are you going to live there? How long do you plan on keeping this asset?
Right.
Because that's what it is. It's a liability and an asset at the same time, right? If you're living in it. And it's how long are you going to be in there? And if it's 7-10 years, which is what the average is in the US, then what's that appreciation look like over that 10 years of your life?
Right. What are you going to owe, and what
are you going to owe? How much you going to pay off? How are you going to use it? Is it going to turn into a rental? Right. All of that stuff where you're building that equity in your house and building that wealth. So,
well, the other thing that you're doing when you do that, which I love that term that you use for it. I think that's fantastic. We have a lot of people that will call and they're like, my lease is up next month. Mm-hmm. And now they're kind of stuck.
Yeah.
They didn't plan. They didn't strategize. They didn't prepare for it. And so then they're kind of left in the lurch there. So I love, and I always encourage all people call and go, I think it's a little too early for me to start talking about this. It's never too early to start talking about it, ever. The more you prepare, it may be that maybe you need to save some money before you do it. Maybe you need to get credit and whatever it is. I think it's never too early, and it's so big to be ahead of it. Just if somebody's PCS in here, don't do it 30 days before you're supposed to be here. Obviously that can be done, but
we do it all the time. Right. The stress level for the client, I feel for them is like when you're trying to do all this stuff, you're moving to a place, right? It's, some have been to Fort Campbell or know somebody that, or military, whatever, in that realm of it, but a lot haven't. So they're like trying to figure out education, trying to figure out all of this stuff.
Right.
And they're doing it and then they're coming in on a weekend and flash sailing. And it's like, is this really the right house, or are you just doing this out of desperation?
Right.
And that's some of the things we got into with the house when they were 2% and 3% interest rates. We have people in their house that bought a house. They don't love the house. They bought it because they had 16 other people writing offers on it, and they just settled on it. So it's like, so you just have this caveat of stuff that's going on. So,
yeah, I the further ahead you start, the better options you have, for sure. Yeah.
Now that we've kind of covered all that, is there anything else that you're seeing that we haven't talked about with interest rates, rate cuts, or words of encouragement you can give to our...
I like the words of encouragement part. So I just think that the big focus, what everybody should hear is, it's still a buyer's market right now. That everybody is different. Every person needs something different, wants something different. And so, take the time to come meet with you, strategize, talk to somebody in the mortgage business that can help you budget, help you look at it, and find out what works best now. Is it best to do it now? Is it best to wait? What options did they have? I think a lot of people feel like they just don't have the ability to buy a home when they really can.
Right.
So I would just challenge people to, even if they think they can't, there's credit repair, which we have. If that's an issue, if they need to save some money, we talk them through that. I'll even sit down and show people how to budget if they don't know how, and how to, save that money over time, or show them other options. But I just think that they definitely shouldn't take it as a one size fits all. They should look into it for themselves individually, because there's ways to get super creative and that would benefit them financially in other ways. Like we said, with the debts and, price range, the rates, all of it together, just leaves just a ton of options for people. So.
Yeah. Well, it's always a pleasure to sit down with you and have you on our show, on our podcast. So see y'all next time, and thank you again, Amanda.
Bye.